We have an amazing panel today. There's been a lot going on in the market. I think that speaks partly to why we have such a big crowd here, more so to the quality of the panel we have. But I'd like to call Tony Quattrin up. He's Vice Chairman of the National Investment Team at CBRE and a very accomplished broker in this market. So Tony, come on up.
Welcome. It is an honor and a privilege to be moderating the NAIOP Investment Kickoff Breakfast for, I don't know, 14th, 15th time. It's always a privilege and provides great insight. I get to come out at the beginning of the year, get wise, knowledgeable panelists to share their secrets with me, sets my business plan for the year, and you learn a lot. And I think today with the panel we have, you're going to learn an awful lot. For example, over the years, I learned it's really important to go to the washroom before you come on the podium. So, if you're insightful as I am, you're going to take a lot away today with the group of panelists we have here. So I'm going to bring the panelists up and we're going to just jump right into it. So Avtar Bains, long time in the business, over 40 years. Shenoor Jadavji, come on up. Eric, Shenoor, I'm going to take the middle seat. Rose between two thorns, as they say. Now, again, I thank NAIOP for inviting us here. I thank all of you for coming and attending. Again, I think Ted was right. You're here because markets are particularly volatile, and we want to understand what's going forward, what's going to happen, and how to navigate the troubled waters we've been in and the troubled waters that still seem to be in front of us. Because of the quality of the speakers, sage, wise, experienced, successful, I can't say enough accolades about this group. I'm going to ask all of them to give them a little brief overview of themselves, introduce themselves, what they've done, what their business is, just for those of you that aren't familiar, to get a sense of how much they have to give and offer and what they've accomplished. So Avtar, why don't we start with yourself?
Okay, so Eric Carlson, getting older. I still feel like I'm 40. I felt like I'm 40 when I was 25. I feel like I'm 40 now when I'm older than that. And I founded Anthem Properties. We're an investment development management company. We have 3 real estate groups. We have vertical development where we build high rises, low rises, and shopping centers and some warehouses. We have land and house building where we buy large swaths of land and turn it into suburban communities. They're very state-of-the-art, very eco-friendly, build houses. And then we have the income property group where we focus on food-anchored retail. And in the last couple of years on warehouses and food-anchored multifamily rental. We're up to about 700 people on the team. We got about $6-7 billion of assets under management. I say that now because cap rates have probably come down, just saying. And I don't want to acknowledge how they have come down, so I have to give a range. And I think we're a culture-friendly, organizationally driven business. We've been around for about 1,000 years. So I'm eating a lot of Wheaties and doing my push-ups.
Thank you.
Shenoor Jadavji from Lotus Pacific, or Lotus Capital now. Started about 25 years back. We're a small investment company, but we play in the industrial and multifamily spaces across Canada. We've done stuff with some diversified REITs over the years. We've also built a little bit of industrial here in BC and some multifamily. Our focus is opportunistic and value add. We do fewer deals for greater returns and been around for too long. It's an exciting time. I think we're at ground zero. This is the year you look at 50 deals and you do 3.
Avtar Bains, the name of our family company is Premise Properties. We're a modest company. The raison d'etre of what we do is based on 2 words, and those 2 words are cash flow. We want to build secure, reliable, growing cash flow over time. We do get involved in development situations, generally with partners, but we're not diversified per se. We're diversified geographically, but not necessarily within a lot of different asset classes. So we're modest, but we still want to grow, and we're looking for security in our asset class.
Thank you. Avtar's been around for a long time in the business, even longer than I have, and for many, many years, top broker, competed against them, watched them go success in business. Eric, many, many deals over the years, probably the only group I ever actually thought about working for at one time. We debated on that for over a couple of years. And Shenoor, we've done so many deals together, so many beginnings and starts and co-investing. It's been great. So the panel, the attendees here today are looking forward to learning a lot from you. I'll just sort of kick it off. These are key decision makers making hundreds and hundreds of millions of dollar decisions all the time, either through advising or investing themselves. And they have a lot on their minds to worry about. And just to give some things, the geopolitical scene, it does play into their thinking, but it's nothing they can do about. So it adds that extra pressure. And, you know, if you look at the world today, the geopolitical landscape, it's pretty scary. We've got a country below us that we looked at was going to protect us, and our biggest trading partner maybe going to elect a twice impeached insurrectionist as their next president. We've got a left-wing communist dictator starting a ground war in Europe, threatening our trading neighbors to the Western Europe. We've got a ground war in the Middle East, and we've got a pending ground war in the Far East, run by another, communist dictator. So it's a pretty scary place out there, and lots could change. If you put them all together, I think Shenoor said, well, maybe we've actually got the beginnings of a world war again. But at least out here in the West, we've got our priorities a little more straight, a little calmer. Our most revered influencer is a woman, and she's a rock star. So, we got our priorities right. And right here at home, we know that there's not a lot to worry about because the Vancouver Canucks are in first place in the NHL. So, for us, all the world is going to be good and none of this other stuff matters. Let's get to the nitty gritty and talk about probably the one thing. We thought that for the most part here, the attendees are a little younger, working in the business for a long time, and really haven't experienced really difficult times. We had a period of lower for longer interest rates, lots of money in the system. Just just put a property out there and somebody will buy it, and we make money, buy, sell, flip. Those days have been gone for a while, and there's probably a lot of nervousness out there. So we're going to talk about a couple of quick high-level statistics, and then get the panel to comment on how they see it, and maybe give you some words of comfort and advice to kick off our discussion today before we get into the analysis of all the asset classes and the investment. So a couple of high-level stats just to sort of, here is, we've seen the fastest and steepest rise in interest rates in the history of central banking. And that has basically put the brakes on everything and stunned the investment community, and we're at a standstill, which brings all kinds of bad things with it. You can see the other issues, the other lines there. Now, a lot of these slides are going to be quick and fast. Don't worry about it. Copies of these will be available after, so you can get a hold of them. But this basically saying we had the savings loans crisis in the 90s, the tech meltdown in the 2000s, the financial crisis in the 2010s, and then of course now we've got the inflation-driven interest rate crisis, and you can see how fast and steep. So no wonder we put the pause on. We see investment sales down across the board, across Canada, everywhere, 23, and again slow in 24. There's nothing to buy all through the 20-teens, and money was looking for home, and cap rates were dropping, and now the shelves are full and nobody's buying anything. You look across all asset classes here, every single asset class is down significantly, and we can't trade. So, and then here you look at what the money sitting on the sidelines. There seems to be lots of capital out there. This is one of our stats, but all of it is for value add and opportunity. So in that environment, lots of bad things happen. We don't like it when things aren't trading. I really don't like it. But Avtar, maybe you can talk about, give this group that's mostly younger, mostly haven't seen these areas before. We've seen it before. You've seen it before. What should they do? What should they think about? How worried should they be? It's been going on for over a couple of years now.
Well, somewhat regrettably, I'm now old enough to remember what happened in the early 80s. And it was, we had a peak in 1981, even though interest rates were a bit higher, but there was definitely a peak. And I talk about peaks, it's not really just focused on valuation. The real issue was liquidity. There was great liquidity in the marketplace. Whether you were selling something, whether you were leasing something, there was a demand on the market side. And then 2 short years later, 1983, we hit a wall. And I remember it was Rookie of the Year in 1981 or 1982 at Colliers, the old Macaulay Nichols Mayland. And I remember well, I did a couple of deals and they made $102,850. And I said to myself, wow, in year 2, I'm going to do double that. So in year 2, the market changed and I made $800 a month. It was $8,900. And that's how much the market changed between 1981 and 1983. And we were depressed. were depressed. But we hung in there, and over time, the next peak was 1989. And in 1989, we experienced actually better liquidity, more reasonable interest rates, but lots of demand again on the liquidity side. In 1989, we thought, okay, we're out of it. We got clear sailing ahead. And as soon as we thought we had clear sailing ahead, we hit 1993, which was the most difficult market in the history of British Columbia for liquidity of commercial real estate. It was terrible. What we're experiencing today comes nowhere close to what 1993 was. I remember 1993 being a broker and saying, you don't have to pay for the property, it's yours. And they still said no.
Was it hard to get paid on that?
And they still said no. And then there was another peak in 1989. So in the early days, pre-COVID stuff, in the early days, what we experienced was the typical Vancouver cycle, at least in my experience, was 7 to 8 years. From peak to peak, from low to low. Okay? And in that 7 or 8 years, we typically got a year and a half of a buying market, a year to 2 years of a buying market, a year or two of a seller's market, and 4 or 5 years of pretty normal supply and demand. Then we hit the new millennium and we went on our run. We went on a run that heretofore has never been seen and may never be seen again. And we used to joke until a year and a half ago that there's people in the commercial real estate asset class that are 32, 34, 35 years old that have never experienced one cycle. So now we're in a down part of a cycle. And again, liquidity is the big issue. So this is people of my generation, especially Gino, who's here, at least my generation, thank you for laughing.
Eric and I might be the only
understand
ones.
that there will be better times ahead. But if you're under 35 or 36 years old, you may think, wow, how are we going to get through this? So the trick is for young people is please understand that we can't let the dynamics of the current marketplace divorce you from the market. Now is the time for young people, all of us in this room, to embrace the market. Embrace the dynamics that are evident in the marketplace. There are many advantages of a down market, which is hard to maybe grasp, but there's tremendous advantages for a down market. And from my lens, I think the down market is the best time to learn your trade, to refine your skill set. Absolutely. In a down market, is the best time to learn the discipline necessary to get through your challenges. I think in a down market, you'll understand better the value of relationships. And the real estate business is a relationship business. I think in a down market, this is where we all learn how to add value to the process. In an up market, everyone's a star. In a down market, you can differentiate yourself. And the biggest advantage of being in a down market for everyone in our business, this is the time to increase your market share. You don't increase market share at the height of the market when there's 1 million participants. You increase your market share as it's going up, where there's less people thinking that they're real estate experts. So there is a future, especially for the young people. I'm taking way too much time here, I apologize, Tony. But we've been through this before. We will get through this. Liquidity will come back. Valuations will improve. And we're going to feel pretty good about ourselves. But it may be a couple of years before we get there.
I think that's marvelous, Avtar. Thank you. And I led with Avtar for a reason, because he's been a broker and an investor and an advisor still. And I think that was some of the strongest advice. And I'll go to Eric in a second for a little bit different perspective in Shenoor, but one of through the good times that Avtar said, well, you're not really learning anything. You're just writing paper, someone's accepting it, and you're flipping it and making money. Everybody looks like you're here. You're not really doing anything. You're not really learning anything. You're not really getting anywhere. And I agree with everything Avtar said. Young people would come to me and say, Tony, can you help me? How do I overcome this objection? I don't know what to do with the money if I sell. These big prices that we're getting back in the teens. And I used to look at them and tell the guy to take the money off the table because it's an amazing price and the buying opportunities are going to come back. And they would look at me like I had, how can that possibly be? But it was good advice and sound advice. And you're taking that lesson away in this market. Sell when the markets are good and buy when they're down. Eric, from running, after that was excellent. Thank you. And I think it's what a lot of people come here to hear and understand. Eric, from running a big company, nobody's trading, nobody's transacting. You got a whole team of analysts and meet people that want to do deals and they feel like they're spinning the wheels. How do you keep the motivation up? What do you tell them? How do they get through these times?
I wanted to answer the other question.
Well, it's the same thing. No. It's comfort. It's comfort. You can answer that too. You go ahead.
Okay, I'll answer all of it. So I'll take 20 minutes here. I'm teasing. So just on the adversity thing, the early 80s, the early 90s, I guess right after 9/11, the global financial crisis, there's always adversity and then there's always a recovery. And I think that the early 80s, that's when I graduated from university, 23% interest rates. You can go be a real estate developer. You got your university degree, couldn't get a job. Everyone in real estate lost their jobs. Like if this was that breakfast at that time in this room, there would have been like 5 people. Like everyone's gone. Like it was a complete reset. It was a massive recession. There was a huge oversupply of inventory. And I think that, that adjustment was very, very painful. But of course we did adjust and we came out of it, as Avtar said. And so I think it's important to remember that whatever's going on, to the extent that socialists don't fuck it up, market's clear. Things recover. You just have to kind of let people go through what they have to go through. So when there's adversity, we'll get through it. This too shall pass. You just have to have the conviction and the creativity to have to find a path to get out of it. It may mean you have to downsize your house. It may mean you have to change your job. It may mean you have to take a step back before you can take a step forward. And I know that sounds metaphorical. When you're feeling the pain, you go like it's not very comforting. But that's exactly what you have to do. Because you get through it. And it's not going to kill you. It's just going to make your life less pleasant. It's not going to be less fun. You're not going to Nightingales for dinner. You have to.
Yeah, well, this generation's okay with that, right? They're not used to instant gratification at all.
Yeah, exactly.
So how do you motivate your team? How do you get them in these difficult times?
Okay, so anyway, in terms of what's different this time, because it's always slightly different. They would say it's different this time. It is slightly different. There's no big oversupply of inventory this time. This isn't like we overdid it, so now there's a recession. It's a monetary correction based on way too much easy money for way too long, which we got away with because of globalization and technology innovation. We still have technology innovation, but globalization is kind of taking a complete U-turn the other way around, right? Like that kept saving us. Like stuff at Walmart, they used to lower prices, prices are going down. So we can get away with that loose monetary policy. We can't get away with it anymore because we're deglobalizing. China's going this way with Russia and Iran and all the other winter states. And the West is going this way with Biden and Trump and all these other, Justin Trudeau, all these loser leaders, right? So we got to get through all that and adjust for that. But there's no oversupply of inventory. So I think that this hardship that you're going through, it's like this incredibly easy era is over. And now it's normal. Get over it. Like you just have to go.
So when you walk into a
boardroom,
my dad grew
up in the Great Depression.
You walk into a meeting room and all your team is there and they go.
Okay, so my guys in my company, we lay off 50 people. I don't know. We obviously the issue is there's no capital now. We use our money, but we always have partners. What we do if partners are keeping money close in because they don't know what's going on or because they're getting reallocated, we can't get capital to go do deals, right? No one can, and that's the issue, and that's why volumes are down. So, how long is that going to last? 6 months, a year, 2 years?
Okay. Yeah. So that's the message. It's gonna pass.
It's gonna pass.
Shenoor,
okay, is that your way of saying shut up?
We gotta get through this topic. But
we're gonna get it through.
We're trying to give it comfort. So
go ahead.
If you don't do that,
no, wait, it's Tony's turn because this is the Tony show.
Just to summarize Eric's analysis of the question I tried to ask 3 times, is if you don't finish that valuation, you're fired. Is that it?
Yeah. basically.
So there's a motivation there that's a little different than this
Well,
is going
no,
to trade.
okay,
And
so-
you're going to get a big bonus at the end of the
I'm
year.
going to finish.
No, it's Shenoor's turn.
No,
Shenoor, we're going to move on. We got lots of topics. Shenoor, yeah, now, your team is smaller, you're more nimble, you're more footed, you're in multiple markets. But how do you give comfort to this room from a smaller organization? Because a lot of people here come from those type of organizations. How do you see it?
Well, look, I think both the other speakers have spoken about the economy, the difficulty of getting capital, the difficulty around liquidity, and then the uncertainty around interest rates. And I think that if I look back, the first bad cycle I saw was 93, and it was super difficult, and I was in the brokerage environment sitting across from him. And I think, it was super hard to do deals. I went from being rookie of the year to making 20 grand. And it was like, oh my God, how do you survive? Can't even support the car. And so I think, look, cycles come and go. This cycle to me, we've been in an amazing place for the last 15 years. All we've done is deal after deal and chasing deals. I don't even feel like my office needed me because they just underwrote and then added 10% to it or something like that, and we'd buy it, which was really uncomfortable because I kind of actually like cycles like this, where it's roll up your sleeves, it's ground zero. This is where the opportunities start. Start looking around you. I think Vancouver is not the easiest place to do deals because it's not a place of cash flow, it's a place of appreciation. And when you're in a situation where you're looking for appreciation when interest rates are doing what they are today, that's a hard place to sort of see. It's a little bit longer out. So for us, we don't really focus on any one market. Vancouver's been the market that we've spent the least amount of time in. We spent a lot of time in Alberta, out east, and the Maritimes. And our objective is to look for assets that are undervalued and to see, is there actually movement in rents still? And you'd be surprised. Other cities and other provinces have repriced already, and they're getting aligned. You're not seeing negative leverage like you are in Vancouver. So for me and our team, it's like we're at ground zero. We've got dry powder. We've got the least amount of assets we've owned in a long time because we sort of have this cyclical pattern of how we do business. And I'm like, we're going to underwrite 50 deals this year, probably do 3. But in 2025, we'll do 25 or 30 deals. But that's just getting ready for it. And I actually think for the team and new members of the team, this is going to be a struggle because it's like, well, what do I do? How do I get optionality in a deal? I think everyone's talked about what's happening outside, what's happening internally in your organization. How are you viewing that deal? How can you be creative? What can you bring that's different? And you're not going to get the bonus, and you're not going to get this, and you're not going to get that, and you can't go to Harry Rosen and buy a suit. Just settle down and get to work. That's my model right now.
I like it. Well, thank you for that, guys. And that's a little bit of indulgence, but I think in the economy that we're in today, this was an important topic to kind of cover. We're going to get now into what this is all about, which is the review of the investment market and outlook for the year. We're going to go through it asset by asset class, and I'll set the stage in a second. But I think the key takeaways there, it was a cycle. It's happened before. We've been through it. It's going to be good again. I liked your statement, Shenoor. Was it 50 offers and 3 deals maybe? We just keep trying, keep digging, keep going, one foot in front of the other. And, you got to do the work because if you don't, you won't be here when times do get better. So I think great stuff from the panelists, and thank you for the indulgence there. So let's start talking about the market. I just set up a little bit. Of course, this market is all about high interest rates. That's what's driven us here. So the real culprit in our frozen markets, our lack of capital, lack of liquidity, is the markets. They say those rates might be coming down. So you can see here's some of the prognostications or prognosis or future predictions for interest rates coming down going forward. So that's when the good times will come back. We see the headlines are talking about it. Rates are held. They were held yesterday in the States. The stock market blew up anyways. But there seems to be this, it's going to happen, but that seems to have been going on for quite a long time. And of course, we've seen in each previous cycle, as the panelists were referring to earlier, rates have come down after they've gone up. Almost to what goes up must come down. So if rates are going to come down and they're high and there's no money and nobody's buying and there's all this product, the shelves are full, as we saw earlier, are we entering a generational buying opportunity? And is that yes or no? And is that across all asset classes? So let's start, even though this is NAIOP, as Eric tragically informed me at the beginning of the meeting, we're going to talk about residential because for investment world, it's an asset class. It's a food group, which people tell me never to refer to it as, but it is one of our main food groups. And it's been the one in the most topic. It's the one we're always worried about. And everybody in here needs to rent or live in a home. So we're going to spend some time talking about multifamily as an investment, as a development, and should we be doing it or not. So I'm going to lead with a few more lies here. The press loves to talk about it as a crisis. You know, is it an asset class in crisis? Is it an asset class we should be investing in or building or developing to? If you look at here, CMHC tells us we're undersupplied by 3.45 million homes in Canada. In BC, this goes back to 2012. The green line shows in each year what we built, what we needed by people moving here, and the green line below shows what we were short. Today, we're 250,000 homes short in Greater Vancouver. We are never catching up. Immigration, we need homes when people come in, and they're saying there's going to be 1.3 more million people coming to Canada, 300, 400,000 a year. And as we all know, you know, they're not going to Winnipeg. So we're going to have a bigger problem here as we go forward. So guys, in light of that, and we have the lowest vacancy rate in North America, of course, and we've had the highest rental rates going up in Vancouver in a long time. So in the light of that, and I'll go to some maybe negative reasons for multifamily. Are you buying multifamily? Are you building multifamily? And I know this is going to be a bigger topic, and we're going to take more time here because there's lots of things to discuss. But Eric, you're the developer. Let me start it off. Multifamily, great asset class.
Yeah, well, we're talking, there's rental and there's you know, homeowner, home occupied, all that.
Well, we can buy land. It's all investment, right?
Yeah, the whole thing,
Yep.
sure. So for generational buying opportunity, no, I don't think so.
But look at the stats. Look how good. Rising rental rates, no supply, lots of people. How can it not be a good? I love it.
Okay, coming back to capital and interest rates, that's the problem. I also I'm trying to fit within your framework here, so I'm just gonna have to adjust to my framework here for a second here. Okay, so it's a bit stuck right now. Okay, so it's all true. We have low interest rates, we have huge demand, they see supply. Supply can't keep that demand. Why can't it? The capacity is constrained. Why is capacity constrained? Because of the approval process and because of the cost of capital. I think it's that simple.
You know, the mayor's here, right? So be careful.
Well, yeah, sure. Interest rates, availability of equity from pension funds are all going through their asset reallocation thing right now. So for example, if you have a portfolio of purpose-built rental you're trying to finance with pension funds from Toronto right now, you can't get the money because they don't have money to invest. Some do, but not much, not nearly as much as they used to. So even though the market needs that portfolio and there's a developer there ready to do it, it's going to take an extra 6 months to a year just to form the capital. So that's one constraint. On the approval side, there's a lot of talk about, oh, great, David Eby's he finally has supply side, mantra, and he's going to force the municipalities to rezone land, and so that will free up capacity, and that's a good thing. And so he's getting a little bit of praise right now. We're forgetting about the 6 years of demand management policies that were totally half-assed from that Tom David off of UBC that were a piece of shit that bogged the market down for 6 years, and we just couldn't, like the market was getting discombobulated all the time, combined with overzealous development, like planning staff and the political side. Everyone was going to solve the housing problem by interfering with it and regulating the shit out of it, right? So we're sort of through that, maybe, but it's one thing to say you got to rezone land, but you still have to get infrastructure to catch up. You have to do your development services agreements. You have to get through your DPs and all of that. And cities need capacity to do that too. So it's not to wave your magic wand and say, rezone your land. You have to actually have schools and roads and sewers and infrastructure. And these cities, I have a lot of empathy for them. They do, well, if you don't give us capital for that and for hospitals, we can't keep up. And so it's still going to be bogged down. So I think that the stuckness of the residential market in Metro Vancouver will continue for some time. So if you can actually form capital, you could pursue an asset class where for sure you'll have demand, you'll achieve your pro forma revenue, but can you manage your cost in such a way you can actually make profit? And we're sort of in that discombobulated state now, and so we're kind of stuck.
Get some slides here. We're going to talk about the problems later, but I'm going to move on and I'll come back to you on the same topic. Shenoor, are you buying multifamily? Do you see the opportunity here, Vancouver, or even other markets? Multifamily investment for this year for you? Part of your 50 offers, will they be multifamily?
I think right now I'd say that it's the hardest time to buy multifamily just about anywhere. But I think in Vancouver more so, just because, we were, with the interest rates being what they had been, we were buying sub-2 and repositioning existing stock because rents were low and putting money back in for the newer stuff. We got trapped into the rezoning process, which took a very, very long time. And I think part of that is regulatory, but I think that part of that is also you don't have enough staff in a lot of municipalities to accommodate this kind of growth. I think when you look at over 1 million people coming in, I agree with you. That is the generational opportunity. But what falls behind it doesn't support it.
No, the question was, is it? I didn't say it is. I'm asking you, is this? I want to be clear.
I think it is. It is absolutely. But how do you make it work? And I think it's a partnership because you've got costs, you've got interest rates, you've got timing. All of those things are working against you. So if one of those could work, and I think that I got to listen to the mayor of Halifax the other day, and, it was like music. He got up and he said, well, we've got a city, we've got this much immigration that's come in, we've got affordability, we've got jobs, we can build, we've got zoning that allows for 30 stories. We need to increase that to 40 and just, we don't need to go through a whole process.
Where was this?
Halifax.
Halifax.
It sounds like the other side of the
Halifax?
country, but they're getting actually the same amount of immigration on a per capita basis that we are. And it's fascinating because their returns are there. They are looking at infrastructure and putting money into infrastructure, and they're looking at creating densification, because the only way that you can actually accommodate the generational opportunity is to create this kind of densification. But Tony, I think we are actually doing that in some ways. We're not doing it at the level I'm buying at, but if you look at the First Nations and the amount of development they're doing, if you look at the sort of there's city building going on right now, Jericho across the bridge from the Broad Street Bridge on the south end, if you look at what's happening out in Coquitlam, et cetera, you are seeing it, but it's being done with scale. And I think that kind of scale affords larger organizations to play and others not to, because they're really well capitalized. So for us, we're going back to smaller secondary cities to see where there's opportunities, where there's return and not negative leverage, and to buy newer product and actually get better cap rates that make sense. Because in the end, multifamily behaves like a bond yield. It's the safest investment that you can have out of the food groups.
Well, it should be a generational buying opportunity, but those are some of the roadblocks, and other markets are some of the solutions for investors. Doesn't help Vancouver. Avtar is multifamily a generational buying opportunity from development, value add, condos, apartments,
Actually, I'll take a pass on multifamily.
investment. You're not doing any multifamily?
Not really.
Well, what do you think? You're one of the smartest guys I know, most experienced in the room. Should people be buying? Look, one thing I know, the price has been coming down.
Yeah, I think the issue is where the value is. I think the marketplace is going to very much pursue value over asset class. Where I see the generational opportunity in the Canadian landscape, I think it's going to be more than a generational opportunity. I think it's going to be a seismic shift on what's going to happen with the commercial landscape in Canada in the next 3-4 years. So some people in this room, the young ones, may not remember these names of Trizec, Olympia, New York,
Bromley.
Hammerson, Bramalea, Michel Campo, Lang, the big 5 banks.
Olympia, New York.
So when I got into the business, the majority of the best real estate from coast to coast was owned by these groups. Some of them were public, some of them were private, and certainly the banks were involved. And in the 90s and the 2000s, the vast majority of that real estate changed hands to the institutional world of Canada, be it the Caisse de Dépôt, Ontario Teachers, Ontario Hospitals, AIMCO, BCIMC. So that was a big shift. Where I see the generational opportunity in the near term is going to be in office, if you've got the stomach for it, and in retail. Because the groups that own the majority of the best real estate in Canada will and are net sellers of their assets. So who's going to backfill it? So when Trizec and Bramalea and O&Y and all those guys went through trouble, the pension funds were there to backfill. Okay? If these billions and billions and billions of dollars of supply come on the market right now, who's going to backfill? Is it going to be private equity? Is it going to be public entities? Is it going to be offshore capital? That's going to be the $64,000 question in Canada. I sit on the board of Primaris REIT, and we're maybe one or two or three buyers in all of Canada for major retail at this point in time. And so we're only a year and a half old, but recently we bought Conestoga Mall in Waterloo from Ivanhoe Cambridge, and we bought Halifax Shopping Center from Imco, which are both great, wonderful assets with lots of land and upside with the land. And right now we're in discussions with the top owners of retail in Canada on a private treaty basis.
After, can we save a little bit of that? Because that's great stuff. I know those deals. We're going to talk about retail at the end, but and I think those are great stories for that topic, and we do not repeat it. But again, multifamily. I want to finish with this. Look at you and I have been doing this forever. You're a broker for a long time. Shenoor's a broker. The fundamentals couldn't be better. Lots of people, high rental rates, no supply, and we don't think it's a good investment, Eric?
No generational buying opportunities. It's if you look at what I kind of have this expression saying, you know, you can't buy shit for $1 million in Vancouver, right? A 2-bedroom condo in Vancouver is going to cost you $1 million, 900, $1.1 million. I don't mean that cavalierly. It's kind of where it's at, and it's not driven by, you know, excessive profits or money launderers or gangsters or dentists from Calgary or any other people that we blamed in the last 6 years for it.
Be good to have those guys back. We may get some buildings built.
You're talking about, but the market taps out at a point because they just can't afford to go above that. So if the price can't go up, the housing unit has to change.
Well, here's your slide. I mean, This is it. Basically, this just says here much.
So I'll
here's
finish my point. Thank you.
Yeah.
So you have to. What can you get for $1 million if that's where you tap out, or 600 or whatever? Pick a number. And so it used to be a nice 3-bedroom house in North Vancouver that I grew up in for $26,000 in 1967, right? And now that house is like at 2.5 or whatever. But anyway, coming back to the price point you pick, that has to shift down. So for that price point, it's like it goes from a house to a townhouse to a 2-bedroom condo to a 1-bedroom condo
to a rental
studio to a tiny little micro unit. And so I think that the opportunity within that, we have to change. It's a very tough thing to do. You have to change land use policy. You have to change our paradigms. We have to change our expectations. And that's tough and it's work. So the land will kind of stay where it's at. It might go up a bit. It's not going to be like, oh, well, there's demand's huge, supply constraints, so it's going to go up in value, which it should. It's because the demand is sort of like the shape of the demand curve. It's sort of it's not inelastic anymore. It's very elastic, and so you have to fit within the constraints of what that demand curve looks like. So I think that the opportunity in housing isn't generational per se to go make a shit ton of money. It's to be very, very creative and very, very collaborative with all the people who have a stake in the community to find these new housing solutions. If you do that and you do it at scale, you can make some money. But it's not generational. It's not a big, huge windfall like it could have been in the past. I think it's just going to be hard work. And that's fine. It's farming. We're not hunters anymore. We're not going and killing the animal and hauling it back. We're like working hard and planting little seeds and pulling out weeds, and it's hard, and your back hurts, and you get a little crop this big, and you make a 10% IRR instead of 20, and you're going, that's it? Yeah, that's it. That's the way it is.
Well, you know, here's obviously a very big block, and I have a lot of sympathy for what the panelists are saying. I mean, nobody can afford even to rent if you look at this slide. The average income doesn't make enough for you to rent an average 2-bedroom household if you're a family. So, and certainly you can't buy a townhouse or a condo, or definitely not a single-family home based on the averages. Now, we know averages don't tell the whole story, but that's a fundamental that's there, and it's underlying and permeating, you know, why Eric's not all over this, despite decreasing cap rates. I mean, having more land receiverships than we've ever handled in our history. So land's getting cheaper, cap rates are decompressing, and these guys still don't want to buy multifamily. And Eric doesn't really know how he can afford to build it because there's no equity. So something's got to give. I mean, the government gets in and tries to help, right? And I think this is where we run into some problems, right? They say, well, we're going to get out there and we're going to encourage it. And if you look at some of the headlines we've seen over the last year, they're trying to get involved and make a difference. And I think they just keep going. No, you can't rent to Airbnbs. You can't have foreign investors. There's a foreign investor tax. If we buy a house in here and you're a foreign investor that kicks off a condo, you can't rent it out. So you can't get income, so you don't buy it. you get lots of money at CMHC, but there's all these low-income housing you got to get to make your performance work. Government just keeps going, and I think that nothing they've done yet, really has helped. And I think one of the overriding facts is rent controls, and that's not even one of these headlines on here. I mean, why would you invest in something when the government says, well, I don't know, we might raise taxes? Is that some of the problem? Are these the problems for the fundamentals say multifamily should be a great investment? Are these the reasons? Eric, maybe some comments on this?
Yeah, well, I mean, I don't want to sort of repeat myself, but yeah, it's hard. It's like what I was saying, and you showed all these slides that sort of
Well, it's
illustrate
just a feeling, right? It's just a sense. They keep doing stuff that doesn't work. Shenoor,
Yeah.
you want to comment a bit?
I mean, I think you've talked about on the buy side and on sizes of units, but I think, there's also going to be a cap on rents. Everyone seems to think that we can get to $7 a foot. And I don't think that's possible. I think you have to look at people's salaries and how much income has increased and disposable income has increased. Pretty much more than 50% of people's income is going into housing costs in this city right now, which is problematic. So, that's an additional thing. You've got cost of construction, land costs that maybe are coming off a little bit, timing. Every one of these things needs to be looked at, and maybe one of the solutions in terms
I can tell you
of
land costs are down by over 50%, and it's going down more.
Yeah.
The pro formas still aren't working.
They aren't working. Well, they're not working because you also have the issue around insurance and property taxes, which if your rents go up and proportionately your property taxes and your insurance go up, your bottom line is still actually going down. And that's what we're seeing here, is that, we can get the additional rents, but they're being eaten away. So the overall return, like, you used to be able to buy and say, okay, I've got a 14 IRR, it's dwindling, and it's dwindling in the operations, even though, especially if you're going to add value. Let's say you take something that's older, you redo units, and you do it organically so that you're not creating disruption in the market. You make sure that you do the exterior of the building. Maybe you do some, environmental improvements that help the energy part of it. But in the end, all those have added value to the property, which in turn increases your insurance and increases your property taxes. So you just can't, it's a really hard win right now. How do you make money in this asset class? And we don't see it. We're just sort of, especially here, it feels very confining.
Thank you, and that's the problem, and we got to get capital back. Avtar, I appreciate you're not an investor directly in multifamily and you want to pass, but you are advisor to a lot of the biggest developers in the city, and you do help advise one of the biggest equity providers for multifamily development. What's your take on all this?
I think my take on it depends who the counterparty is.
Sorry?
It depends who the counterparty is. It depends who's interested. If you're a first time entering the field, I wouldn't call it generational. Like, it's generational for people that have the infrastructure. It's generational for people that have the asset management. It's generational for people that have the cash flow to support the buy, right? So to look at deals independently as first-time buyers is a lot different lens than someone that already has a portfolio. So I do agree with you that product's going to be coming on the market that has the quality of being generational, but it's not for everybody. If you don't have the back office to deal with it and the cash flow, it's not generational.
Would you, as a group, and maybe just yes or no, would you be more interested in investing equity or buying or building a multifamily project if there were no rent controls?
The problem is, if you wanted a solid 6 or 6.5 or 7% return today without any stress, you're better off paying debt than you are buying something at a 3 or 4.
Well, where are you going to put the debt if nobody's building anything?
No, you're better off paying off existing debt.
Paying off debt.
Yeah, paying off existing debt. Because you know,
not investing in debt, paying off debt.
Yeah. So that's actually a better investment right now because you're not dealing with CapEx and you're not dealing with property purchase tax, you're not dealing with this and that and boilers and pipes and this and that. So it's, I think a lot of people are looking, especially in our asset class, to first prioritize their balance sheet over certain investments.
Eric, change your opinion if no.
Yeah, no, just to reinforce the point. It's hard work, and your returns are going to be mediocre, and that's the way it is in residential and Metro Vancouver. I'd say in Western civilization, but in particular Metro Vancouver. And you do, so why do you do it? You do it because it's what you do. You know, it's like you farm wheat or rye or barley, and well, we farm wheat. So you just come back and you do it stoically year in, year out. And when you do that, some years when things clear up, if they do because of some existential event we haven't figured out, you make some extra money. And in other years when you don't, and things cloud over you, like interest rates go up, you make less. You just gut it out and you grind through it. I think that's the way it's going to be. And maybe that's the efficient markets hypothesis, although it's not that efficient. I want to come back to your headlines here. Just very briefly. Everyone's trying to solve the problem of not enough housing. It's a big deal. It's very expensive. People are very concerned about it. And I think the problem is we have these old paradigms as individuals. And so we vote accordingly with our old paradigms. And we vote for politicians to say, we can solve the problem. We have a policy. We're going to do this, we do that, we do this. And it's happening at the federal level, the provincial level, and the civic level, and now Metro Vancouver, whatever this NGO thing is over here that has power but no accountability. And they're all working against each other. So when the federal government says we're going to reduce taxes on this thing over here to help housing, Metro Vancouver does a new levy on all new development the same week for almost the exact same amount of money, completely undoing the benefit of the policy. So we're all working at cross purposes, and we all have these old paradigms we come in, like developers are bad, and the dentists from Calgary, and the foreigners, and the gangsters, and all that stuff. And so that's actually why it's such a grind. And I think that we could have a freer market, we could build stuff faster, we could make that adjustment, all these creative little housing solutions, which will all be expensive, but they'll get smaller per dollar of value. But we have to listen to each other. And a lot of us just have to get out of the way. You know, if you don't have the ability to contribute to the conversation, then get out of it. Lead, follow, or get out of the way, or it works. So
I agree. We're going to leave this topic because
that was an
we're
anti-government.
going to leave this topic. Thank you so much for indulging us. I think it's such an important issue in our industry and for everybody here today. And thank you for taking some time. Despite great fundamentals, I can't sell anybody an apartment building. It's going to be a tough year for me. I'll leave the government with these 4 thoughts. After you said something brilliant the other day that, you know, if you, one great politician said, if you want people to behave in a certain way, motivate them to do so. MERBs, we probably built thousands and thousands and thousands of doors in the multi-residential unit building, which is tax advantages for investors that invest in multifamily by the government with accelerated write-offs. Get rid of the capital gains tax. If somebody sells their land and it goes into a multifamily project, could be something that motivate cheaper land and quicker land. Accelerated depreciation. We used to have 10% when I got in the business, right after. That's what it was, 10% depreciation on your multifamily buildings. That might help. And get rid of rent controls. There's lots of things governments can do that are positive. So far, they've been trying to help by fixing it themselves with little knowledge. So we'll leave it at that, and we'll get on to, if I can't sell a multifamily building, maybe I can sell an office building. Guys, office is pretty good too. We built 4 million square feet in the last 6 or 7 years. It's all full, pretty much. 91% occupied, pretty good on office. If you look at the pipeline, these are all the buildings that can be built. They're in for permits, they're under there. We know all the different players. I've talked to every single one of these developers many times, and I can tell you, I promise you, nobody is building an office building here for the next 5 years, so you don't even have any supply coming. So not only do we have the lowest vacancy rate in North America in Vancouver office space, our vacancy rate is going down, if you believe the future graph here, if no new supply, and we just do modest absorption. We got a great market. Are you buying office? Are you building office? Avtar?
You know, if I had a different balance sheet, maybe I'd look at.
Or people you advise?
Yeah, like the problem with office is the cost to maintain the tenants. You know, the TIs, the CapEx that's necessary, and making the asset ESG compliant, et cetera, et cetera, et cetera. So there's a burden there that some people do not want to absorb, which makes it difficult. But the bigger issue is, even if equity was interested in the asset class, the debt is not correspondingly as kind. And very few people are going to pay all cash. And as my dear friend James from Realtech has told me, spreads on office products, they're not 75 basis points. They're not 150 basis points. They're going to be 200, 250, 280, 300 basis points.
So you're telling me that the debt guys can't read these stats?
No, it's the perceived level of risk. Like just this morning, I was reading an article about, I think it was a Japanese bank that had to write down American office assets. And there's another article right after that of a German group that had to write down American office asset. So you're right, it's hard to go against the grain when you're seeing write-downs all across the world landscape. So it's hard to get financing. You have to have deep pockets to hold the asset. And for private equity, it's very, very difficult to compete against institutions. It's not that office is entirely out of the picture. A friend of mine right now is offering $100 a square foot on Class A, AAA office buildings in the Phoenix, Arizona market. And he is getting responses at $100. So if we could buy in Vancouver at $100, there's a bid.
So at a price, you're into office.
At a price that there is, yeah.
We're just not there yet.
Yeah.
Shenoor, buying office?
You know, it's not a
You know,
space that we play.
let's give you a little help here. You're buying office if you're director of a big pension fund.
Well, not if I have to report to my shareholders because they're going to be scared. I do think there's an opportunity, but I think you have to have incredibly deep pockets, and we're seeing it, obviously not here because of the amount of inventory we have, but if you look at the Alberta market, Calgary, Edmonton, there's deals happening at 30 and 40 bucks a foot, and you're buying on a price per pound basis, but you've got to know that you're going to be putting in anywhere from 100 to 200 bucks a foot between tenants, TIs, and CapEx. So, you know, are you still in a good place? If you can do lease up, great. I think you have to understand the economic story of where you're buying, and I think each of these markets is operating uniquely. I don't think Toronto is operating that way. I think we're actually very lucky because we didn't build that much. I think it's just the whole story of having incredibly deep pockets and probably having 3 to 4 years of patience to get that occupancy in the building.
Eric, what's your thoughts on office?
Yeah, so if I was that,
If you look at these groups, nobody's building. Would you pick up one of these sites at the right price and build it?
not to build an office building. So if I was that pension fund person you talked about, how would I approach office? Very delicately, because I probably totally overweighted it because it would have been a sort of a core strategy, and now you've got all this office space. There's Vancouver, which is unique, but you know, Calgary, Toronto, you know, the rest of the United States. I think it's about 1 billion square feet of office space in the United States that's not occupied. Some of it's leased, but it's not occupied. So that's got to be managed. That's a lot of square footage. Atlanta, Georgia has 25 billion square feet of unoccupied office space. I think Manhattan has 75 million square feet of unoccupied office space.
You know, that office space is dated and old and nobody's ever moving
Yeah, no,
into it.
there's
That's a unique problem.
Yeah, I know. Again, finishing my answer. So, just.
I'm just always a
so
broker.
I was going to say it's not about a city get office. It's not about A versus B versus C in a city. It's about that building in that location with a rifle shot, because that building might be well priced relative to the unique characteristics of the lease and the quality of the tenant. And so maybe that's an opportunity. It's become quite entrepreneurial. So you can't have this sort of asset allocation theory, go get X million square feet of that in this country over the next 2 years to get this sort of general return, like a regression analysis. It's going to be more entrepreneurial. But to Avtar's point, entrepreneurs don't have the kind of capital that is required to buy those big buildings in those big cities. So where are the rifle shots going to be? They're going to be maybe in those B and C properties. They're emptying out as tenants take advantage of low rates in the A buildings, the tenants that remain. And maybe they're going to convert them to rental, or maybe they're going to come up with something we haven't even thought of before. I mean, multifamily rental. You know, the entrepreneur is going to start showing up in this space a little bit, I think. And smart, agile pension funds will be active here, and some big family offices. But we have a big, huge mouthful of office space in North America to absorb. I was talking to a senior bank executive yesterday, and he reminded me that he works, he goes to the office Tuesday, Wednesday, Thursday, but not Monday, Friday. And I went to a meeting at that banker's building in Toronto on a Friday, and you can shoot a cannon in it. So that's 60% of 100%. Somehow that space has to kind of fit. So you got to get through all that. So
So are these the
rifle
issues?
shots. So
Is
the
work-
deal that you're going to do, or the two deals, are going to be the rifle shots, and you're going to do them because you're really good at telling guys where to point the gun. There you go.
Well,
Tony.
you know, I've always-
master broker.
I've always
extraordinaire.
just believed in fundamentals. And here we've seen great fundamentals in multifamily. I can't raise money to build it or people to buy it or trade it. I got great fundamentals in offices and nobody wants it. That you talked about the work from home, if that's an issue. Are these the changing? Is this what's causing office space? Is it the existing vacancy? Because I got good fundamentals and people are at work here on Fridays for the most part. Is this the problem? Is it remote work? Is it, I bought a new suit for the day. Should I have just bought LVMH pajamas or something because I'm going to be working from home? I mean, it is a changing landscape. There are different thoughts. Is this a part of the office space? I ran into one of my colleagues in San Francisco. She was the head of retail leasing, but up at the ICSC. And I talked about office and how that city's destroyed and the homelessness and all the things that's coming to Vancouver, and we got to avoid the San Francisco plate. And she said, it's not that bad. It's nowhere near like that. The new buildings are all full and they're getting record rates. It's the old buildings, your New York example. Here we're mostly new. Our buildings are mostly full, but I can't sell an office building.
But there's still 75 million square feet unoccupied.
This
right?
is going to be a tough year.
Yeah.
All right, let's move on. Industrial. Now, here's an asset class that really changed in the last few years, right? Rental rates probably went from 8 to 24. That's a pretty good run. Cap rates compressed well into the 3s, even the 2s sometimes if the rates were so low and people were hoping on higher rates. We see the lowest availability among major markets in North America and Vancouver still. Our vacancy rate, rental rate growth has been phenomenal, as I said, 3 times. Cap rates still seem to be kind of where they were, but rental rates have gone up, so maybe some of the growth is gone. Vacancy rates in Vancouver, oh my God, they've tripled. They've gone from 1 to 3, so maybe that's a problem. Are we buying industrial? Is there an opportunity there? If not here, elsewhere? Because I can work in other markets. Shenoor? You dabbling in industrial?
Yeah. So I would say to you, 10 years ago, we bought 5 million square feet of industrial.
Sorry?
You were part of our big acquisition, about 5 million square feet. We bought at an 8 cap and we financed at a 6 because that's what rates were at that time. Are we back there? Yeah. And I think there are markets that you can buy in where you're not at an 8 cap, but you're at a 6.5 or 7. And that's just not possible here because of the vacancy and because of the limitation of how much we can build. Other places can build way more, and there's more availability, and it'll continue. For instance, in Toronto right now, in the Greater Toronto, we're all talking about if you're 100,000 plus, it's really hard to find a tenant because distribution is, for instance, changing. So I think there is an opportunity. I think you have to be cautious in where you decide to do it. We've always played in the B space, which is becoming a little bit more difficult and it's something we haven't talked about today, is sort of the ESG component and the rules and regulations that are going to come in for older buildings that are 30, 40 years old. How are you going to be able to get them to meet the carbon footprint? Can they withhold solar panels on the roofs? So there's a lot of practical issues to think about. And again, we don't do a broad stroke on let's go out and buy a bunch of, industrial across the country. I think we're using the rifle approach in terms of which markets we'd like to be in, but we're a buyer.
So industrial, maybe in the right circumstances. Avtar, are you buying industrial anywhere? Victoria, I know you're busy there. Is this a buying opportunity here, or?
Yes, we're buying small industrial in Victoria, and we're very happy with the deals that we got in the last couple of years. We were kind of 3 lots short, 3 60-footers short of assembling an entire city block, 1 kilometer away from downtown Victoria. So that's going to be opportunity for our company downstream to redevelop that site. Subject to leases right now, but we like the space. In Toronto, we've got limited exposure to the industrial asset class, and it's been very well supported by the tenancy market. So we're pleased with that. But we're certainly not overweight in the asset class. We could absorb more, but it's a question of yield versus debt.
If you were going to look at a newer industrial building in Vancouver, leased right around market, what cap rate would interest you?
Depends on geography, but I still think it's a sub 5. Still think
And
it's
would you
sub
buy it sub 5?
if I thought the rental upside was there. And really, it depended also, industrial is the underlying land, okay? Because there are zoning changes that one can take advantage of in the industrial space. And some very, very creative developments have occurred in the last 3 or 4 years. And indeed, in many respects, BC and companies like BD have been the leader in that regard.
Leader, absolutely.
And really set the standard for what's happening in other markets in Canada. So it's really quite exciting and great for Greater Vancouver to have that kind of forward thinking here in Vancouver.
And there still seems to be a lot of capital for industrial. Problem as a broker that I have is, there isn't anything there isn't anything to buy. Eric, the industrial guys always tell me that these rents went up so much because really the cost of the rent to an industrialist, it was really not the rent in the building. It was really the cost of trucking and gas and those things, and availability, and rents weren't that important. Nonetheless, they moved this industrial all the way to Calgary because Vancouver ran out of land, and you're investing industrial in Calgary. My understanding is that market may have gotten a little bit overbuilt with some of that enthusiasm, but it's still good there. What's your take on industrial now going forward in Calgary, where you're active?
Yeah, I really like industrial, and it's I think it's more because of the way its role has changed in our society. It used to be like a scrappy warehouse you'd store stuff in, and it was kind of dirty. And now it's automated, and it plays a very large role in the supply chain, and that sort of direct to consumer, or the last mile. There's all this new opportunity for these new forms of building, and so obviously there's more space required, and so there's opportunity. To the extent that it exists in small markets like Vancouver, it's very, very expensive, so it's hard to make a lot of money in it. So I come back to my farming analogy. And we found that we could farm better not here. And so we're mostly active in this in Alberta, where there's a little more growth, a little more space, the beaties aren't as big there as they are here, just saying. And want to slowly over time become better farmers and get a bigger farm. So we pursue it, but to just go out and buy a straight income property at sub 5 cap rates without some angle to add value, it's too hard to make money. I can't even pay for the fertilizer, for crying out loud. So, I want to be more of a value add development approach to it in that asset class.
Well, most of the industrial developers and owners are not traders. So even though we maybe have some buyers, I'm not going to be able to make my year on industrial either. So it's going to get tough. Maybe retail. Avtar will give you your shot here. Let's move to the retail as an asset class. Again, a couple of stats. I always like the fundamentals. If you look at this, the retail is active. This is occupancy by major REITs. So all these REITs are, including, I think Primaris might even be on there, but they're all retail REITs. Average occupancy at 97%. All they own is retail, so that tells me it's in good health. Our vacancy rates in Vancouver have plummeted, and sales are quite strong all the way along. It seemed to me that retail is a great asset class from fundamentals, but as we've seen earlier, it really doesn't seem to matter about the fundamentals, whether we're buying it or not. But Avtar, you mentioned you are buying. We can start with those enclosed malls. They're a little different. I mean, here's a couple strips in Vancouver that traded recently. I don't know if a 4 cap in retail, which is negative leverage, or 4.8 and 4.9 is a generational buying opportunity, because there haven't been a lot of retail trades yet. When we get the retail, there seems to be a lot of activity. Eric, 75 shopping centers. Shenoor, you've done bought and sold and added value in retail. After start with you, because I cut you off earlier, my apologies, on your retail take on that.
Right now I'm getting a lot of great information about the retail asset class being associated with the Primaris REIT. And as I was saying prematurely, the product that we're seeing right now is unprecedented. So if there was a generational opportunity to grow in Canada in major food groups, it would be retail. There's lots of pension funds that are definitely overweight in the asset. With our last 2 deals, though, major deals, I think Conestoga was $270 million, and I believe Halifax was $350 or $360 million. Both doing great sales per square foot. The Halifax shopping center was doing $900 a square foot, and it's a large mall. And even if you took away the Apple store, sales per square foot for the average blend would be $725, which is a good sales ratio. but we're not buying at a 4, or was that say 4.9? Yeah, we're not buying at a 5. On the regional shopping centers, Primaris, we're getting effective cap rates between 6.5 and 7%.
Any development with that? Any opportunities? Any development upside with that?
Unbelievable land upside.
Yeah. So there's that.
Unbelievable land. There's millions and millions of square feet of potential density to cultivate, which I don't think we're going to be doing ourselves. But the land upside, we could subdivide and sell off land and repatriate some of the capital that way. But the retail asset class, even in BC, where we bought a couple of properties from RioCan a number of years ago in Kelowna and Vernon. And Vernon has just been an all-star. When we bought, we had kind of inherent vacancy in the elbow of the shopping center, very difficult to lease. And lease rates 4 or 5 years ago were $20, $22 a square foot. Now the shopping center is 100% leased, and lease rates in Kelowna now are $32, $33, $34 per square foot. So the growth in the Okanagan and the Thompson has just been phenomenal. It has been much more than we ever forecast it would be. Kelowna, we're getting the same experience. We've had some tenant transition, but the backfill demand has been, again, greater than expected. So we're very happy with retail. In Toronto, Greater Toronto, Peterson and I are involved in a shopping center in Brampton, Ontario. And we love Brampton, Ontario. Brampton, Ontario is Surrey, BC, 10 or 15 years ago. The opportunity in that market is just phenomenal. So the more immigration that happens in Canada, the more people move to Brampton. So lots and lots of upside there. We're very happy. And we've got an 18.3 acre site with around a 230,000 square foot shopping center on it. But the ultimate use of the land was essentially a covered land play. And I think we're going to receive between 3 and 3.5 million square feet of density. We'll never build it ourselves. Sorry, we'll never build it ourselves. But sometimes retail is also perhaps the best covered land play you can find in the Canadian landscape.
Exactly.
So retail is really performed beyond expectation. It wasn't killed by Amazon. I see the sales growth figures in 35 or 36 or 37 mid-size and major malls across Canada every month. And sales are going up. I can't imagine what sales would be in a retail asset, enclosed or otherwise, if there was no e-commerce.
Okay, we're gonna, great to hear that at least somebody like shopping centers. Eric, you're doing something similar, I know, or looking at something similar that Avtar has been doing, and you also own a lot of strip and retail all throughout hinterland, BC and Alberta. What's your take on retail?
Yeah, I really like retail. We focus mostly on food anchored retail because it's steady and reliable, and we always thought it would survive the whole sort of, online shopping. And because people like the experience of like touching their food, right? Not too much, and not during COVID, but all the other times. And so we'll do that. We'll just buy an existing one. We don't have to add value to it, but we love adding value. But if you look at Strawberry Hill, I'm not picking on Strawberry Hill, but that photograph, look at that. That is like a juicy farm that needs to be replanted, right? Like, look at all that land. Look at how low density it is. Like, so we actually...
I think it came with a 29-unit apartment building to be zoned and built, but it's...
fair enough. I'm just using it as a metaphor, right?
Yeah.
For what needs to happen based on the change in human behavior, which is, we need all these different forms of housing. We want to not drive our cars as much. So we don't want big surface parking lots where you drive 5 miles. The grocery store, you want to take your elevator down from the highways, walk half a block, there it is. On your way, you get a coffee, right? So that sort of live, work, play opportunity for these types of shopping centers where you repurpose the retail so that it's still relevant, like big old department stores aren't, but you take the land that was there and you repurpose it. So the value add opportunity with that type of asset is huge. And so we really like that.
Are you happy to sit on the low yield till you get there?
Well, I kind of look at it as land inventory with a carry, right? And frankly, the opportunities now, because you have to have the skill set to be able to do what I just said. And most asset managers don't have that. right? So if you can get the capital to believe in you, then you can go do that with your toolbox.
Back to capital. Okay,
Right,
we're out of
so-
time. I
yeah.
got 2 quick questions for you, so we're going to move on. Thank you for that. I actually feel good. I might actually be able to sell a couple of retail centers this year, and it won't be such a bad year after all. So just to prove we're not all about statistics and numbers and data, I have a question for you. I actually was, would have probably been an English major if I wouldn't have been in real estate. So here's one of my favorite poems from high school. Carlos Williams. People have been here maybe 5 or 6 years ago. I used this before, but so much depends upon a red wheelbarrow glazed with rainwater beside the white chickens. And if I had to memorize a poem, this is the one I chose because it was short. So this guy, of course, Carlos Williams here is talking about the agrarian economy and the importance of the wheelbarrow to get the crops from the field to the trucks, to the grocers, to the fertilizer, as Eric said, to the fields. In our economy, if I were to ask you groups, your 3 wise panelists, and one word answer because we're out of time, on what does so much depend? On what does so much depend in our real estate economy, on the bricks and mortar, invest in capital markets that we work in? On what does so much depend going forward? If you could pick one thing that's not a red wheelbarrow. After?
Interest rates.
I was going to say, can't say interest rates, but you said it. Okay, Shenoor, interest rates are gone.
Oh.
Give me another one.
Okay. What
Yeah, Shenoor,
depends?
you can live with that. I'll take it because we're out of time. Shenoor, another one.
It is interest rates, bond yields. I think that's it.
Eric.
Why are the chickens white? They're always white.
I think it's the contrast.
Okay.
The big issue is capital.
Capital.
Availability
Thank you.
capital.
Avtar.
Conviction.
Sorry?
Conviction.
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 Belief.
Yeah.
Okay. So have conviction, have capital, and interest rates. Last question, I'll let you go. I'm going to make this one easy. It's difficult to make predictions, Yogi Berra, especially about the future. And the last thing I'm going to ask you for one. A year from now, we're on stage. I've already made my prediction. This was the front page of the Western Investor in January. I was already wrong, so I don't feel bad to make your prediction because I've already blown it. Over under 3 interest rates next year, since that was on what so much
Which
depends.
index?
3, the 5-year bond rate, I think it's 3.6 this morning, 3.5. A year from now, over or under 3. That's where they price the mortgage rates off. That's kind of why I threw that out there.
Over.
Over, Shenoor? Avtar?
Under.
Under? Eric?
Okay, 10-year government of Canada bonds, to be more definitive, is exactly 3% in a year.
Exactly 3%. So over, under, and on. So there you go. You learned nothing today. As I tell my people over and over and over again, real estate is about people, the bricks and mortar that we build for them, that they live in, that they rent. And today, it's all about people again. Thank you for coming. Thank you to the panel. It's been great.